Let's just have a look at really the broad backdrop really of really what's leading to currency weakness here and the dollar at 109. In fact, is that really what's keeping the dollar, the yuan weak, or is it also a weak story in China? Let's get a sense of that. George Sun, head of global markets for Greater China at BNP Paribas. Yeah, George, help us answer that question, because up until recently, I'd say up until about a month ago, you could make the argument it was mostly dollar strength. But since we last spoke to you, I think it was late July, a lot has happened in China, weak data and so forth. Do you think that's getting incrementally more a weakness story in China too?
It's getting factored in. Good morning, David. Good morning, Ivan. It's getting factored in for sure into the currency. However, actually, the renminbi, maybe it's not so correct to only look at that one pair, the dollar renminbi. I mean, everybody watches it, look at the 7.0 mark as almost like a resistance point. But maybe we shouldn't only look at that because it's not just a DXY at 109, 110. It's a renminbi index actually at 102, which is actually a pretty high level. Actually, the renminbi index at 102 is weaker than earlier this year when it was at 106. But it's much stronger than in the last 4 years when it was in the 90s. So if you look at almost all the other currency pairs against renminbi, against the yen, against the Korean won, against the British pound, against the euro, the renminbi is actually at 10 or 20-year highs against those currencies, actually. So if you think about it, China's biggest trade partner is actually Europe. So if it goes much stronger against Europe, against the euro, against the pound, against the Asian currencies, actually the one bright spot in the Chinese economy, which has been exports, could slow down even more.
What does it mean for rates then, George? Just given the fact that we have seen policymakers try and step up the stability of the renminbi against the dollar at least, is there limited downside for rates too then because of that?
Well, I think this is where China is quite different than the rest of the world. I think after lowering rates last month, I think probably it'll be kind of held steady until the end of the year, until after the National People's Congress. Probably there'll be quite a few policies that will have a big difference before and after that National People's Congress. You talked earlier about the COVID zero policy. It is pretty tight right now, but I think that's to make sure nothing really happens before the October 16th Congress takes place. Afterwards, maybe there would be a bit of loosening up that we would expect, and then maybe that's when you would want to do more stimulus on both the monetary and fiscal side, because then there'll be more effect actually if people are a little bit more opened, and the consumer spending and businesses will spend a bit more, perhaps after policies, after the MPC.
Right. Well, I wanted to follow up then on that. Do you think investing conditions then improve after the Party Congress, George?
Well, we just came out with our fourth quarter outlook, and we do believe there's probably more upside risk than downside risk after the Party Congress, meaning that some of the policies will be better aligned to support the economy, because it is really weak right now, actually. The macroeconomy is very weak in China right now, very different from, let's say, the U.S., where, let's say, in the U.S. you have relatively good employment, good consumer demand. You don't really have that in China right now. Consumer demand is quite slow. Unemployment is ticking up. It's probably worse than the numbers show, because you probably have migrant workers leaving the cities actually and going back to the countryside. So they're not even getting factored into the unemployment numbers right now. So I think overall the demand is slow. You don't see inflation as you see in the rest of the world. We just said PPI may be coming down to 3.1%. CPI is only 2.7%. So you don't really see any of the demand-driven price pressures. So it's basically a slow economy at this point, and we'll need some policies to turn it around.
Yeah, and I wonder just how much that pent-up demand is there. George, maybe you get a feel that now that you're back in China, if they do at least ease up on some of these COVID zero restrictions, how quickly do you think growth can bounce back next year?
That's a good question, Ivan. I think we lowered our growth estimate for China for this year, for full year, to 3% or even less GDP growth for this year. But we think that even if there's a moderate reopening of the economy, if there's a moderate improvement in the COVID policies, let's say going into end of the year next year, we actually are predicting something like a 5.3% growth in GDP next year, which will be a relatively strong rebound, actually. So we do think there's a lot of slack in the economy that can be picked up once businesses start investing again, once they have some certainty. I think the certainty is a really important thing. You can see kind of in the U.S., after the Fed is so clear about the higher for longer, things stabilized a bit, actually. Whereas in China, people are still kind of uncertain whether to make the business investments, whether to make the big consumption investments, because they just don't know when that when the policy will get back to a kind of a more accommodative stance.
2.5% on CPI, 2.8%, and the reason that there's almost a negative connotation there that almost is indicative of the lack of demand in this economy, that's a big miss. PPI is also, that's a substantial miss, 2.3%, 3.2% was the expectation. That's virtually half of the 4.2% PPI number that we got in the prior months. So again, not that it's a secret, but this is an economy, obviously, that's not really firing on all cylinders. Let's get initial reaction right now from George Sun, head of global markets for Greater China BNP. He's joining us still from Shanghai. So, I mean, George, I mean, inflation is not a problem in China. In a way, it's a problem in many places, but I guess that underscores that being a problem in itself. You know, when you have a look at, say, earnings forecasts, it comes down to that when you're an equity investor, right? There's an earnings recession now that's being priced on MSCI China. Is the market cheap enough, given what's still quite a fluid economic situation to the downside?
Yeah, good question. I think it's probably too early to say. If you just look at where the equity markets are now, you know, CSI 300 around 4,000. That's quite a bit lower than before COVID. It was about 5,000 pre-COVID. Whereas in, let's say, the U.S. markets, with the U.S. S&P at 4,000, that's significantly above the 3,500 before the pre-COVID. So it looks cheap. The China equity market, it's about PE ratio is about 12 versus 18 or 19 in the U.S. But the problem is until the economy fully reopens, until there's demand from consumers and businesses, the earnings are going to be challenged. Right now, there's a lot of liquidity onshore in China. Monetary policy is not the problem. Last month, there was an extra $1 trillion of infrastructure and lending that was released into the markets. But the problem is that the companies, the consumers, are not demanding this credit creation. So there's not enough uses for for this credit right now. And right now, that's why you don't see any pressure on employment. You don't see pressure on consumer prices, producer prices. So the economy is very lackluster at this point until this National People's Congress, and there's a bit more coordinated efforts to get the economy back on track. Right now, you see a little bit of small parts here and there. I mean, one part that was really hindered in the past was the property market in China. So right now, you're starting to see in some cities, like in Zhengzhou, the local governments are saying they're going to be providing the stimulus to finish the uncompleted housing projects so that consumers will start paying mortgages again and not boycott on the mortgage payments.
And George, you've highlighted as well that, you know, the three major regions of this world are dealing with big problems right now: inflation in the U.S., energy crisis in Europe, slowdown in the economy in China. Does this mean that we just, you know, central banks, at least DM, have they actually reached peak hawkishness?
Well, what's good, I think, in one respect, is that definitely with the Fed and the ECB, they've come to the realization they are at their peak hawkishness, it looks like, actually. So if the Fed is going to go another 75 in September and maybe 50 in October, 50 in November and let's say 25 in December, the Fed is quite serious and the ECB is quite serious. They both said they want to get down to the 2% inflation target. But the real question is, our research team at BNP Paribas is thinking maybe we may be entering a different economic regime actually after this year and going to next year. Maybe 2% is not the right number anymore for our target for inflation globally because energy prices are higher. They're going to be higher. Labor force is tighter than before. So the inputs are going to be more expensive. So maybe 2% is not going to be the right target. If you start getting in that direction, that helps the economy. But I think the fact that the Fed and the ECB have so clearly stated their target and that they're going to be very tough on hawkishness, I think the one good part is that it gives the people a bit more certainty as to their investments, as to as their business prospects. I think the U.S. is much better off than Europe at this point, because in many ways the U.S. is a self-sufficient economy. It has its own sufficient labor force, sufficient natural resources, whereas Europe right now is really facing an energy crisis. You could argue that Europe is facing many of the problems that we saw in the 1970s. You got energy crisis, you have a war, you have basically inputs are very expensive, and the GDP will probably be much slower for a longer period of time. I think what's very alarming is that the consumers in Europe, if they're going to have to spend something like 15% of the GDP on utility and energy next year, that's a lot of money that won't be going to consumption.
Yeah, George, you bring up a salient point which has come up really in our conversations here, Yvonne, myself, and Rish. Of course, we've been asking our guests. And one point that's been brought up is this year's kept money out of the public markets and shifted that into the private markets. If your analysts are correct that inflation will remain high over the next few years, how do you convince your clients to get back into public markets where returns will need to be higher to account for higher inflation expectations, George?
Yeah, returns will need to be higher. You're seeing bond yields picking up already around the world, right? So we're seeing, obviously, government bond yields have picked up tremendously. Whether it's U.S. Treasuries or German bonds, they've all picked up significantly, 100 to 200 basis points in the last year and a half. So I think yields are adjusting, and investors will have to get rewarded for the higher inflation with higher returns. The question is, though, when will, on the equity side, when will the companies generate strong enough earnings to justify this? And I think this is where the idea of recession comes in. I think our economists do believe that the U.S. actually can probably avert a more serious recession into the coming months. We believe that actually the U.S. economic activity will be strong enough to avert a recession. However, it looks like a recession is inevitable in Europe right now at this point. So if it's inevitable that there'll be a recession in Europe, it'll take a while for the corporate earnings to pick up. We're a bit more bullish in both the U.S. and we're actually will be more bullish on China once the zero COVID policy eases up a bit.
Certainly we'll take a look at when it comes to these tech stocks as well, because we've seen a little bit more of this kind of pain come back after you're hearing the like of Tencent this week. When it comes to Prosus, we finally found out who that backer has been in offloading their shares, the clearing system. So that was the Naspers Dutch unit. This goes continuing, I guess you could say, trend of what we heard with Warren Buffett when it comes to BYD.
Late in August.
SoftBank when it comes to Alibaba. A lot of these kind of early backers into the private markets now seem to be like, look, it's time to take some profits. Yeah,
reducing their stakes. Let's get the final thoughts here from George Sun, head of global markets for Greater China at BNP. He's with us still out of Shanghai. Yes, I mean, so George, I mean, what do you make of, are we overthinking what's happening there with these early backers? I mean, they came in very early, so there was a lot of money on the table to be taken out. Were they simply taking profits, or was that something else, you think?
Well, I think it is a little bit concerning because they have been in some of these. They've been in some of these companies for 20 years, actually. I think Prosus and Warren Buffett and SoftBank have been in some of these companies for a long, long time. So it's a bit worrisome. But I think I view it more as maybe taking some chips off the table before the National People Congress, before the next 5-year course of direction for the different industries in China. I mean, high tech was an industry that was hit pretty hard 2 years ago, and it's already down a lot. I mean, Tencent is down 70% in the last 2 years, so it's not really taking profit. He could have done that, or they could have done that earlier. But I do think they want to kind of reduce their risk a little bit before a very big party congress in the direction of the of industrial policies, actually. So probably just reducing risk a bit.
Does it in some way mean that the long-term trends of some of these companies, whether it's Tencent, some of these EV makers like BYD, I mean, do you think that trend is now basically turned?
I think it depends on the type of company. I think Tencent and Alibaba are a little bit different. These are the platforms, right? They have a wide-reaching spread, and there is concerns of their possible monopolistic tendencies in the market, from payments to electronic commerce, everything. BYD is a bit different, actually. That falls more into the EV and the electric vehicles and green renewable energy sector. That sector has still continued to perform relatively well, actually. So I would say we're still relatively bullish on this kind of renewable transition energy plays. So these battery companies, these renewables, wind and solar companies, we're positive on that, more positive than on the platforms.
Okay, George, final question. I guess probably the last time we'll speak to you, and the next time would be after the party congress. What's the mood like on the ground in Shanghai, whether that's mobility and COVID, whether that's risk appetite to take on more credit from corporates or investors just willing to remove some of that cash balance that they have sitting around and deploy that in the markets?
Yeah, I would say the mood is cautious, David. I think people are waiting. It's certainly better than the lockdown in April and May, but it's definitely not anywhere near back to a full economic capacity as it was, let's say, last year in 2021. So I think people are in a wait-and-see mode. So if you're a business, you're probably not making the big investments. You're going to wait that extra month and a half to get some direction before you make your big investment. Same thing, consumers are not spending on the big consumer products because they're going to wait. People are concerned about which direction it's going to go in. But I think hopefully there'll be a lot of pent-up demand after the October National People's Congress. So if it's even moderately positive, you'll see some pent-up demand released in November, December.